A little over a week ago, the US Bureau of Labor Statistics reported a bumper July gain in non-farm payrolls of 528,000. Highlighting the strength of this result, July's increase was almost 3 times that seen on average during the 5 years leading up to the pandemic, a period of above-trend growth and ample labour supply, in stark contrast to today. If this series is taken as the sole barometer of the health of the US labour market and consequently consumer spending, arguably the recent weakness in spending should prove but a fleeting lull. Yet the other labour market detail points to a much more fragile outlook. Whereas non-farm payrolls added 1.7 million positions in the past 4 months, the household survey reported that almost 170,000 people lost or left their jobs over the same period. Part of this divergence can be explained away by the household survey running hotter in 2021 and by the fact that household employment counts the number of people employed, not how many jobs each person has. However, we also must recognise that the payrolls count assumes new businesses are always being established and begin hiring immediately. At a time of flatlining activity growth, as well as high financial and economic uncertainty, this seems unlikely. Also worthy of note is that annual growth in new job openings and the hiring rate has collapsed through 2022. Together with the recent weakness in household employment, these outcomes point to a much slower pace of payrolls job creation ahead, at best in line with that seen pre-pandemic. The issue for activity in the near term and the labour market further out is that interest rates are higher today than they were in 2018 and 2019. Also, nominal wage growth for existing employees is materially below the rate of inflation and, on some measures, slowing faster than growth in consumer prices. Combined with rock-bottom confidence, this is an environment conducive to recession and/or a long period of economic stagnation. With COVID-19 becoming less of a hindrance to work and as household budgets and savings are hit hard by inflation, it is easy to conclude that the coming year is likely to see a rise in labour capacity back towards its pre-pandemic level, just as employment growth abates. That combination could quickly result in an increase of 0.5 to 1% in the unemployment rate, impacting confidence as well as household income growth, as employers recognise that they again have the upper hand in wage negotiations. To the extent that we see GDP growth materially below trend through 2022, 2023 and part of 2024, risk to our baseline view of a 1.5 percentage point rise in the unemployment rate to end 2024 are most certainly to the upside. If inflation forces the FOMC to hold back on rate cuts to 2024 or later, even more so. Clearly, the biggest risk the US faces is not a short recession in late 2022 or early 2023, but rather a prolonged period of stagnation that keeps unemployment and underemployment above their full employment levels into the medium term. The cost to long-term productivity and wealth of such an outcome would be significant, far more so than the price of inflation remaining modestly above the FOMC's 2% target beyond 2023. We'll see you next time.